Welcome to SBI's GTM Value Creation Corner podcast with CEO Mike Hoffman hosting. Each episode is an unscripted conversation between Mike and a GTM executive, expert, or practitioner about what's on the minds of executives, the latest market trends, and SBI research and insights. Today's guest is Pilar Schenk, Cisco COO of Global Specialist. Pilar is a change agent and leader specializing in designing and executing go-to-market levers to achieve business-driven results. In this episode, Mike and Pilar discuss strategy, execution, and activation against the backdrop of those who had a growth thesis in tech of growth at any cost.
Hey, Pilar. Welcome to the show.
Hey, Mike. Thanks for having me.
Pilar, I understand you have taken on sort of a bit of a change and challenge or new challenge. I always like the listeners to get a chance to know our guests a little bit more. So, tell us a little bit about your career and path to where you are today.
Yeah. Well, I spent 15 years at Dell, so I kind of feel like I grew up there. And every 2 to 3 years within Dell, I took on a new challenge. So supply chain transformation, I was on that when we had to take a bunch of cost out. Sales transformation, first time we created specialists. And how that worked together, I was on that. EMC integration, I was like, wait, $67 billion acquisition, largest tech merger, raised my hand, and I joined the integration team.
I'm sure that was super uncomplicated. There was no complication in that.
No complication. It was actually a ton of fun. But after 15 years at Dell, I realized, hey, I want to maybe follow where there's a bit more profit pools. Hardware is a tough business. We're fighting for pretty tight margins. And, if we got 2 points of share or 3 points of share, we were really excited because the market wasn't growing at the same rates. Where you could look across and in software, the markets were growing. So I took a leap and I joined McAfee, where I ran global RevOps, and we were private equity owned software, cybersecurity. We were shrinking double digits, and we turned that business around to double digit positive, and we IPO'd, and then we sold it back off.
And I think that's where we met you, right?
Right.
You became a friend of the firm at McAfee, and which is great because as part of this, your background is great because public corporations as well as a PE-backed company, you can kind of think both ways because as we know, public companies and privately backed companies, they think a little bit different about value creation and the timelines in which that comes about.
Yes, but I think there's a lot of pros and cons to that. And one of the things that I really enjoyed at McAfee was it was a very clear remit, right? We were out for E2B. We had to turn around the business within a 2 to 3 year mark. And we were very focused on, shareholder wealth. And in this case, our shareholder happened to be a PE firm. And I think sometimes in public companies, you're playing a much longer game, but sometimes I think you lose sight of potentially the bolder moves that you could make if you had a shorter time frame. So I like having both the perspectives, as you just said, because I think there's a lot of clarity in that motion, and tech moves fast, and we needed to move fast. SBI was a huge help for us at McAfee. We created inside sales teams. We've been doing a bunch of work around renewals. We took on a lot of cost of sale. So it was a really big win. And, and I kind of like to look at markets where if you're not growing, but the market's growing, the problem is you. And that's something that's easy to fix. It's hard to fix markets.
Yep. I do. It is hard to fix markets, and we're going to get to that right now because, right now, just right. Macroeconomic market is hard to fix. But you're right. There is something about having the absolute clarity of a 3 to 5 year run under a private equity sponsor. So that is great. All right. So I want to divide our conversation into 3 parts. And again, we try to keep these podcasts somewhere between 11 and 18 minutes, but actually 4 parts. Sorry. Strategy, execution, activation, and then there's a bonus round that I won't tell you about. But with the backdrop of this, 2023, and frankly, I think it started in the second half of 2022, things got a little bit challenging for those who had a growth thesis, and specifically in technology, because there was the shift all of a sudden from ARR at any cost to, wait a minute, EBITDA, what is that? What does that mean? And so there have been some challenges, and then between in some markets, wage inflation, the interest rates, the debt markets have become more difficult. So with that backdrop, 2023 has been a difficult year so far. And so while we're recording, this is the last business day of September, calendar Q3 of 2023. So going into 2024, if you think about this from a strategy level, what are some no regrets things? Because there's still uncertainty. What are some no regrets things you'd think about in the area of go-to-market or in growth going into next year?
Yeah, look, everyone's facing those headwinds, and I think you always have to be careful on ARR at any cost, right? Cash is always king, and at some point, we're going to have those fluctuations. But we are where we are, and it's time for many companies to make moves. And I always think good companies pull back. Great companies already have a plan, and have been doing this for some time, and it's nothing new. One of the things that was wonderful about my Dell experience is that we were incredibly cost conscious. We were very, very smart with the dollars that we spent because we didn't have a lot of margin to give. And moving on into software, I was really shocked at how we spent our dollars. And then planfully thinking about how we spend those dollars. So no regret move number one is to go look at where you're putting your dollars and the spend and evaluate whether that spend is in the right spot. And the exercise I always like to do, and like if you're not doing it, you should wonder why you're not doing it or why you waited until there was a pullback to do it, is if I had $1, where would I put it and where would I take it from? And I think when you start to do that exercise, whether you're looking at your sales resources, your marketing spend, you're looking at, your spend on a tech stack, your ratios of engineers and ops resources, your inside mix, your outside mix, I think you can find a tremendous amount of spend. And even if you're not trying to cut costs, which in some cases I think a lot of companies are having to pull back spend, but you could also find that, your dollar that you're putting in, are you yielding 2 to 3 back, or are you yielding, 1.2? And maybe you're over-invested in markets that aren't growing. Maybe you're over-invested in certain segments that aren't growing. And so I think it's a really healthy exercise. I would encourage to build that muscle if an organization doesn't always already have it, and then keep it. Because we'll come out of this, right? And we'll start, software will have the margins, will be growing at the same rates maybe we were at before. But we should always be doing this. And I think when I look around, I see a lot of companies who wait only for the time where they have to. And I actually think we should always be optimizing. And it's not necessarily optimizing for costs in this case. It would be optimizing for growth.
That's great. And when you look at, where am I going to put that dollar, and am I going to get 2 or 3 or 4 back? Look at that all the way to the bottom line, because there are lots of examples that we've seen as companies have had to do this transition from ARR, from it's all about ARR at any cost to EBITDA, where you make sure you don't have big cohorts of customers that have a 1.9 year life and a 3-year payback. Just be very conscious, because you might feel good about the top line on some of the places you put that dollar, but in other places, no. So we talked about dollars. Let's talk a little bit about talent, because I feel like talent is a no regrets area to look at. So do you have a point of view on how you look at talent in a market like this and going into 2024 planning?
There's a ton. By the way, I'm at Cisco, right? And Cisco kicks off the year in August. So I'm actually in 24. We've done all our 24 planning. So I feel like I got a head start to this conversation.
That's great. So you can share a lot, because and then the planning that happened was right in the heart of, uncertainty, probably at the peak of uncertainty. Yeah. So this is great.
So look, I think there are 2 things that I look at on talent and that are incredibly important here. One is to look at your productive capacity. And it is a little bit of math modeling, but how many people do you have that are fully productive on the floor? And fully productive is you're looking at the average productivity for that seller and, that particular market. And what I think you find is it's shocking how much attrition hurts you, how much ramp time hurts you, and how much hire time hurts you. So on average, it takes, somewhere around 100 days to hire someone. And a field rep, it can take, 3 quarters to ramp them. And that's if you're doing well. I've studied at companies that I've been at, and actually ramp is 6 or 7 quarters, right? And so that churn of how long it takes to hire, ramp, and get someone fully productive back on the floor is a really, really, really big impact to your ability to go after what you need to do from a growth number. So managing attrition, managing how fast it takes you to hire, and managing your ramp time are levers that we should absolutely look at. The third one, or the other one I always like to look at, is performance. So how are you building up the capability and performance of your middle leaders? You don't tend to, in my belief, get your bottom, the middle to the top. I think your bottom probably need to go. So looking at performance management, and were you doing a healthy job of that? I think in tech there was a tremendous amount of hiring and sometimes recycling of talent because it was in such a shortage. So looking at your performance management and making sure you're managing people out, and then how do you help the people in the middle come up? Right, from a productivity perspective and enablement and capability. And I believe a lot of that comes from the frontline leaders. So talent is huge. I think, it's everything around hiring, ramp, attrition, and then it's looking at the people you have on board and how do you help them either rise up or get out.
Yep, this is good. So there are two things you touched on that I really like, and I agree in the belief in this is number one, just kind of looking at your bottom players. And we challenge clients to do this, and we even challenge ourselves to do this. And it goes like this. I want you to look at every single person in your organization. And if the person that's in the seat right now is not somebody you would hire if the seat were empty, then you have your answer. And then the second one is around productivity. And I think there's a lot of people that overlook this because in the decade of new revenue at any cost, put people on the field, it was really easy to say, hey, our average productivity per quota-bearing headcount is $786,000 a year. It's a lot easier for me to believe that if I add 25 salespeople and I'll do the math on that 786 and I'll factor in the ramp time and all of those things and the attrition level, I'm good. It's a lot harder for companies to bet on. I'm betting that everybody goes from 786 to a macro average of 863 and that uplift. But, I'll go back to your private equity days. In every single private equity deal model, whether it's in the base case or the upside case, it's partially underwritten to sales productivity. And they do just that. Hey, let's say that productivity goes from 787 to 865 with no real, thought about how you're going to do it. But it's so huge. It's such a no regrets thing if you can drive that level of productivity. And I don't know if, across your career, you've spent time on that. And again, I won't ask you anything about Cisco because I don't want you to talk about anything that you can't because you're publicly traded. But you have any commentary on that and your view on whether that's harder to pull off and it's just easier to go, let's just hire 25 salespeople. So any advice?
It is much harder to pull off. The hardest part about strategy in sales is getting it into a habit at the front line. And so driving productivity, and assuming everyone gets 5% more productive. How? I think one of the things that I see as a mistake is a lot of companies don't actually know how much more productive they need to be. And then when they know, right, which I think all of us can develop the math model, what are the levers that you're going to go pull to make that happen? And I think everything we just talked about and talent can do it, but there's a lot of other levers. And if you don't have a plan of how you're going to do that, then that's a problem. I know, I will tell you, just speaking at Dell, we had a productivity increase expectation every year. It was baked into the plan. And we had to go in and say exactly how we expected to get that. What were we doing? What were the levers we're pulling in? Certainly all the talent and it's, managing out, building better performers, hiring, attrition, ramp. But you could be starting to look at things around your tech stack. You could be looking at things in terms of sales, admin time, and how do you get them more time with customers. You could be looking at what they're selling. Are they selling suites? Or are they selling it on higher ASP? And starting to think about your offers. But we had to come in and actually be able to detail that out. And I would say that I don't always see that in other companies that I've worked at, but we definitely keep it. I keep someone on my staff that's always looking at productivity levers, the dollar question, where would I take it? All of these things kind of come together and always optimizing for it so that we can continue to improve that productivity base and get back to growth.
That's good. So I heard a couple of things. So one is, and I'm paraphrasing, benchmark, how are we actually doing? Number two, build it into the plan. Just people will learn, and the teams will learn that I'm going to have to do more next year. And then it's the how. How do we get you there? And whether that's through training and development, or it's through, hey, let's teach you some new pricing levers. Let's repackage a little bit, and then enable the team on the ground. Is that a good summary?
Yeah, you got it.
All right. Okay, you mentioned you talked a little bit about commercial tech. It was in your last. So let's move to execution, and that was my primary thing. I hear all the time. I had a CRO, multiple time CRO, big companies. He said to me, Mike, I feel like sometimes I spend 30% of my time trying to figure out how to get the most out of the commercial tech stack that we have in place. And I hear, every day I hear the sales team complaining, and then, he went on to make comments about, my best sales performers are worst administratively in the communication. So any advice for the group on how do you get better leverage out of commercial technology, and what are some things that you should think about that are maybe low-hanging fruit?
Well, if you're the CRO or you're the sales leader and you're spending that much time on it, then you have the wrong RevOps leader, is my hypothesis. But maybe I'm wrong. I'm just saying that quick gut conversation on that. Look, there's so much out there, and that is awesome, and it is super exciting. But I think it could be really sexy to onboard tech. It's a lot harder to land that tech in a productive fashion at the front line. So I'm a big believer in picking the critical few sales process that you want to influence. There's some that are really important to me. I always hit forecasting. I certainly want an accurate forecast, but more important, I want opportunity and pipeline management. I always have cadence, because I want to drive a sales play engine, and I want to drive growth, and I want to be able to do that in a repeatable fashion. And then I want to look at coaching and enablement and talent. So how do I enable coaching, enablement, talent, all the reasons we just talked about. And then I want to have a really good solution for each of those. I think there's a million things you can buy. What can you actually consume? And so I think your RevOps leader needs to come through. They need to know the vendors. They need to keep the vendors off of your plate. They need to know the problem they're going to solve, the ROI that they're going to put in. They need to build into the sales process. And then they need to see not the adoption, but the outcome, right? So I should be able to quantify, if I put in Cadence software, how much growth am I seeing how much qualified pipeline am I getting out of my sales place? And if I don't know that and I'm not using it, then kill it. Because I think people overconsumed. They bought a lot, and it's not really properly implemented at the front line. It's not really being used. And some of the stuff is really cool, but it has to be used to drive value, and we should just take it out.
Right, and it has to be used, and it can't be a burden. Otherwise, we can circle back to our prior conversation. So first of all, I love the fact that you come forward with a strong point of view, because that's the SBI way as well. This goes back to the talent discussion. If you're spending 30% of your time on it, then you should look at the person in that seat and decide if it were empty, if you'd rehire them. And then the second piece comes back to talent when you start to look at, time study. How much time is the team spending with the commercial tech, and is it more of a burden than it should be? And how do we just get back to the basics where we have the right information, we're not having to pick up the phone all the time and call one another to figure out basic things like the forecast and the roll-up, and did you enter that opportunity? And then, there's the enablement to get people to adopt the technology. So this is all very good, and I agree. And by the way, that was my advice to the CRO. I said, you may want to look at your head of RevOps, who's in that seat right now.
To fair. It should be a means to an end. And if it's not, then you've got it wrong.
All right. So this is the bonus round.
All right.
ChatGPT, everybody wants to talk about it. And you and I both know AI has been around for a decade, and we've been talking about it, and it gets pushed to the back shelf. But now everybody's talking about it, and they're talking about generative AI and how do I leverage that and go to market and sales and marketing. Do you have a point of view on that, or any caution?
Well, it's funny because I see a lot of the commercial tech and relabeling things as something GPT, and you're just rebranding what you've had for a long time. I'm not sure that makes any difference. Look, I think about it as the outcome. It is a really exciting time. I think we need to be thinking within our products, and Cisco does an amazing job. I mean, with almost all of their products, there's AI built in, and I think most companies have that. And we're thinking about how we leverage AI to enhance customer outcomes. And I think the sales tech stack space is doing that exact same thing. But again, it's a means to an end. And it's a portion of what needs to happen. I think the bigger and more interesting conversation, or at least more tangible to me, is the sales process is changing, right? We know that after the pandemic or during the pandemic, customers began engaging sellers later and later in the sales cycle. And they're leveraging, they're going to Gartner, or they're going to peers, or they're doing a lot more research, not by engaging the seller on who they want to talk to and who they want to bring in an RFP. And then they're coming to you probably pretty late with you might do the final two, and then you're influencing price. And so I think as we think about data, and then potentially AI, where I see a very interesting space from a commercial and a go-to-market perspective is how do we put more of that in the hand of our sellers so that they know what's happening out there with customers, and they can either, sales process or in a post-sales process, from a CX or renewals, have better customer outcomes. So we were just having this conversation the other day. If you have a renewal, it's coming up, your seller's it's good, it's commit. But your marketing organization can see out there that customer, everyone in their company is looking at your competitor's website or looking, you have a problem. That is interesting, but a lot of companies don't have those data sets connected and then to a next best action, right? What we should do. And so I think that there's a tremendous amount of power in data that AI will help us as we pull forward to say, okay, what is that action in the sales process? And what I encourage, Cisco, and I think many of my peers out there, is I think that our ability to leverage data, in many cases, you using AI will be a competitive advantage or a killer for those who don't. So you got to just understand that and figure out where in the sales process it makes sense and insert it. And then again, in a sales process, it's the means to end.
I love the example of the renewal and, and having AI or, again, rebranded stuff that we've been doing for a while. That's qualifying it. And then I always ask the question when somebody says, yeah, it's renewal, it's going to get renewed, it's commit. And you go, does the customer know that they're renewing? All right. This is the last thing. So you're already into your fiscal 24, probably when you were doing planning. As I said, you're at the height of uncertainty. There were some bets you made in your fiscal 2023. Did any of those, did you decide, hey, those didn't pan out the way we thought they were going to pan out? And you don't have to be specific. They didn't pan out the way we thought because of the macroeconomic environment, and go, we're going to redo that in 2024.
Yeah, totally. I think, in terms of my planning process that we typically use, obviously there's a financial plan and then what I call the plan within the plan. How are you going to get there? And you make some bets, and some of those work out and some of those don't. And, some of those are your fault and some of them aren't, right? And that's fine. I think it's really good to be able to measure what did happen and what didn't happen and why. And I think sometimes we make the mistake of thinking if it didn't happen, it's a bad idea. And that is not always the case. Sometimes it just needs more time. I mean, how many times I'm sure with an SBI, how many times have you set up an acquisition team, right? And, sometimes I joke around acquisition teams. It's like a hire, fire situation, because we will hire them. We will expect them to be fully productive. We'll get disappointed when they're not quite there. And a lot of times we will give up when, the right strategy, and then making this up right around the 23, 24 might be, hey, you know what? We didn't get the results we wanted in 23, but what we really need is a bit more time, or to adjust this edge here, or to make sure that they have the marketing demand gen or the other things to make it to get there. So I just think just because it didn't work doesn't mean you scrap it. I think you've got to understand the why, and then understand what you need to do to double down.
Yeah, that's good advice, and I am hearing that from a lot of CEOs and COOs is, hey, it didn't pan out in 23. We still believe it was a good idea. It didn't work out because of gravity issues, and so we're gonna go again. So that's good input. All right, So, Pilar, thank you very much for bringing your wisdom to the show and carving out time to do this. I know time is really valuable, so thank you for joining us. And it was a great conversation. I look forward to having another one in the future.
Of course. Thanks for the invite, Rick. It was a lot of fun.
You've been listening to SBI's GTM Value Creation Corner podcast. Visit sbigrowth.com to read SBI's latest research, join upcoming events, or learn about SBI's GTM services. Don't forget to subscribe to this podcast and connect with us on LinkedIn.